Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Monday, everybody. I hope you had a restful weekend, and I wish you all a productive week ahead. Today's video will contain a sponsored feature. Sponsored features are limited to just a few a month, so that the channel is financially sustainable without being too disruptive for the viewer experience. The feature will be labeled throughout, and if you would like to know how I work with sponsors, this information is in the description below. If you get some value from today's episode, don't forget to hit the like button, and if you'd like to see this channel grow and be shown to new people, sharing and subscribing is also a big help. Before we move into the main stories, we note that death and property damage due to China's recent extreme weather conditions continues into this week. Yesterday, Sunday, 15 people were killed after a mudslide hit a homestay house in a tourist area in Hengyang, Hunan province, as heavy rains from a typhoon drenched the region. The day before, a delivery person on a scooter was killed after being hit by a falling tree in Shanghai, caused by storm-related winds. Now, let's begin today's episode with the Chinese economy. In a rare piece of positive news, according to official data released by the National Bureau of Statistics, profits at Chinese industrial firms grew at a faster pace in June, showing some resilience in the manufacturing sector. Profits rose 3.6% in June from a year earlier. That compared with a year-on-year rise of 0.7% the month before. Profits are recovering from a weak performance last year. However, they are still not back to levels seen in 2022. The promising news ends here, however. According to a new S&P Global Ratings report, China's rescue plan to resolve its local government debt crisis has thus far provided only temporary fixes, with default risks remaining significant and the debt pile is set to grow in the coming few years. The report, which was published late last week, found, quote, "So far we see temporary fixes for China's heavily indebted local government financing vehicles. The measures are more focused on buying time than addressing the weak fundamentals of local government corporate arms. Last year, local government financing vehicle debt growth dropped moderately, but was still single-digit growth. We think borrowings will likely grow at a mid to high single-digit level for the next couple of years." End quote. Under the package of measures announced last year, local governments, financial institutions, and investors are all required to shoulder some of the costs of resolving the local government debt crisis. But the report expressed, quote, "In our view, local and regional governments will try to avoid any type of default that would cause systemic risk. However, they are likely to allow low-impact credit events to happen, such as defaults on selected non-standard debt and commercial paper." End quote. The IMF estimates that China's total local government financing vehicle debt hit 66 trillion yuan, $9.1 trillion in 2023, more than half of the nation's gross domestic product. Over the weekend, Peking University Professor of Finance Michael Pettis published his thoughts on this report, expressing, quote, "S&P says that the measures are more focused on buying time than addressing the weak fundamentals of local governments. In fact, there is no way Beijing can rein in the surge of debt as long as it insists on GDP growth targets that are higher than the real economy can sustainably deliver, perhaps 2 to 3% at best. That's because in order to generate additional GDP activity, it must increasingly shift the locus of economic activity to the soft budget part of the economy, where it is possible to get politically desirable but non-productive investment funded. As this activity does not generate net economic value creation, by definition, debt must rise faster than the corresponding GDP. This wouldn't be the case if all of the investment were broadly positive for economic value creation. Over the past 10 years, I've argued that for all the talk of reining in debt, as long as GDP growth targets were set much above 2 to 3% at best, it would be impossible to prevent the country's debt burden from surging. Nothing yet has changed." End quote. Next up, US-China competition. On Friday, the US and China sparred over industrial subsidies at the World Trade Organization, with Beijing asking to set up a dispute panel to review the Inflation Reduction Act's tax credits, and Washington responding by accusing China of hypocrisy. US-based Bloomberg, reporting on the showdown, writes that China described the IRA as perhaps the biggest subsidy program ever enacted. For China, some of the Act's provisions that favor domestic over-imported goods are against international trade law, adding that now isn't the time to ignore the WTO principle of non-discrimination. Bloomberg reports, citing an official, that the US objected to the request to set up the dispute panel, saying the act is an essential strategy for mitigating the global climate emergency. It also pointed out the deep hypocrisy in Beijing, complaining about industrial policy and subsidizing domestic industry. With the US objection, the establishment of the panel was blocked. Much of this was just rhetorical, however. Both countries know that they are entering a deep trade competition. Indeed, they are very much already in one, and China's industrial policy risks putting it into trade conflict with many of its other trade partners too. This is a space we have been following closely for some time and will continue following as we go forward. Meanwhile, yesterday, Sunday, the US and Japan outlined the most significant upgrade to their joint military alliance since 1960, as they warned that China posed the, quote, greatest strategic challenge, end quote, in the Indo-Pacific region. The announcement followed security talks in Tokyo between US Secretary of State Antony Blinken and Secretary of Defense Lloyd Austin with their respective Japanese counterparts, Yoko Kamikawa and Minoru Kihara. After the so-called 2+2 talks, Austin told reporters in Tokyo, quote, the United States will upgrade the U.S. forces Japan to a joint force headquarters with expanded missions and operational responsibilities. This is the most significant change to U.S. forces Japan since its creation and one of the strongest improvements in our military ties with Japan in 70 years, end quote. The new American command, which will initially be led by a 3-star general, will coordinate military operations with the Japanese side, plan joint exercises, and participate in the defense of the country if hostilities erupt. In doing so, it will put America's warfighting capabilities under the command of a headquarters on Japanese territory for the first time, and dispense with the need for U.S. forces in the country to wait for instructions from the U.S. Indo-Pacific Command, which is located in Hawaii, 6,500 kilometers, 3,500 miles, away. The U.S. military plans to overhaul an existing administrative headquarters at the base near Tokyo, named U.S. Forces Japan, to enable it to command approximately 50,000 U.S. troops in the country. The overhaul is among several measures taken to address what the countries said was an evolving security environment. The statement criticized what it called Beijing's provocative behavior in the South and East China Seas, joint military exercises with Russia, the rapid expansion of its nuclear weapons arsenal, and Beijing's foreign policy of, quote, seeking to reshape the international order for its own benefit at the expense of others, end quote. This is all part of the comprehensive effort of the United States to strengthen the military capabilities of its Asian allies. On Tuesday, Blinken and Austin plan to announce $500 million in U.S. financing during their meeting with counterparts in the Philippines. Farther south, the U.S. is helping Australia acquire nuclear power submarines. And with South Korea, the U.S. has removed the restrictions on the range of ballistic missiles the country can develop with American technology. Christopher Johnstone, a former senior U.S. official on Asia policy who is now at the Center for Strategic and International Studies, told U.S.-based The Wall Street Journal, quote, what this means is that the U.S. is prepared to take steps to support allied capabilities in ways that we haven't before, end quote. Adding, quote, the war in Ukraine has driven home the need for added industrial capacity among like-minded states and allies. The amount of material consumed in that conflict has been sort of mind-boggling, end quote. Next up, we discuss China's aging crisis and a growing public backlash to policies in response to it. But first, today's sponsored feature. One of the most interesting and controversial developments in finance in recent years has been the rise of digital assets. Many traditional investors are increasingly interested in having some exposure to digital assets in the higher risk, high return part of their portfolio. However, they want to do so through holding traditional stock assets, rather than dealing with holding digital assets themselves. There is also demand for a diversified holding of these assets. Today's video sponsor, DeFi Technologies, provides an attractive way for investors to do just that. DeFi Technologies is a financial technology company that allows traditional investors to gain exposure to a diversified portfolio of digital assets across the decentralized finance and Web3 sector. The jewel in the crown is the wholly owned subsidiary, Valour, which creates ETFs and issues them. In this report that was published in April, analyst Michael Kim, using a conservative discounted cash flow model, gives DeFi Technologies a fair value of $3 compared to its current quote of around $1.50. And this report came out before the company released their earnings report. DeFi Alpha, DeFi Technologies' specialized arbitrage trading desk, generated an additional 19.3 million Canadian dollars, $14.1 million in Q3 2024 through low-risk arbitrage trades, contributing to a total of 133.1 million Canadian dollars, $97.5 million in cash and digital asset equivalents in 2024. This is a significant return generation, and they are only trading at a PE ratio of 2 or 3. Incredible value. The most recent gains from DeFi Alpha will be reflected in the company's Q3 2024 financial statements, further strengthening DeFi Technologies' financial position and increasing its digital asset holdings. The company is thus profitable, growing, and very undervalued, with brand recognition and a competitive advantage that is durable. And the market is starting to catch on too. It's no wonder that DeFi Technologies' stock value is up over 1,400% year on year, outperforming Bitcoin by 10 times. Year to date, it is up 192%, so we can see some risk with this pick, but also potentially high rewards. DeFi Technologies is a very exciting opportunity for traditional investors to get exposure to this explosive emerging asset class, and, as such, is worth consideration for inclusion in any well-diversified portfolio. We remember that all investment involves risk. This sponsored feature is not individual investment advice. Always speak to an investment professional and do your own due diligence before making any investment decision. A big thank you to DeFi Technologies for once again sponsoring this episode of China Update. Okay, now let's return to regular content. As regular viewers know, China is aging rapidly. Experts and commentators argue how consequential this will be for the future of Chinese growth, with optimistic voices saying it will simply be a moderate headwind, while others argue that the transformation could be fatal for the Middle Kingdom. The crisis has certainly presented policymakers with tough decisions, but one policy which isn't up for debate is raising the retirement age. China's retirement ages are low by advanced economy standards. 50 years for female blue-collar workers, 55 for female white-collar workers, and 60 for all males. This exacerbates the country's old age dependency ratio. Using a broader definition of the working age, then set by the current retirement ages, the Center for Strategic and International Studies estimated that China's old age dependency ratio was 21% last year against 27% for the United States. It then calculates that this is set to rise to 52% in China by 2050, compared with 39% for the United States, hitting 53% in China by 2100, compared with 55% in the United States. The already battered pension system in China is also in serious risk. The Beijing-based Chinese Academy of Social Sciences think tank forecasts that China's basic pension insurance fund for urban enterprise employees nationwide will peak at nearly 7 trillion yuan by 2027 and then decline rapidly, running out by 2035. And this doesn't even cover hundreds of millions of rural residents. As UBS chief China economist Wang Tao observed last week, quote, "Some people get a very nice pension, and then there are the 70% of people who get a pretty low pension or don't have any pension. But even the 30% receiving the nice pension is already not going to be sustainable." End quote. Raising the retirement age will not fix this problem, but it will help mitigate it somewhat. Indeed, during the recent third plenum, Beijing committed to gradually raise the statutory retirement age and allow voluntary participation, saying that the move was necessary. However, this will be easier said than done, as the suggestion has already sparked public rage and backlash online. UK-based The Financial Times reported on this over the weekend. Quote, "The controversy sparked by a line in the report on the meeting's resolutions that called for the retirement age to be raised as China's demographic decline threatens to leave it with too few workers is a reminder to powerful party leaders that this is one area where even they need to tread carefully. I suggest that the experts die early," snapped one younger user on Weibo, China's equivalent to social media site X, in response to pundits' assertion that delayed retirement was essential for the economy. Besides saving money, older experts' early demise would open much-needed positions for young people struggling to find decent jobs, the user added sarcastically. The generational divide over the retirement age underlines the challenges for policymakers trying to deal with a growing imbalance between China's working age and elderly population as the country enters a period of rapid demographic decline. End quote. Later in the piece, the outlet argues that the policy suggestion, quote, "spooked younger people already worried about the record-long working hours and poor employment opportunities as China's economy struggles to recover from the property crisis." This tension spilled over into anger when rumours spread online that the retirement age would be extended to 65 for those born after 1990. One online commentator said that the younger generation, born when they said there were too many people, grew up when they said there were too few, too old when job hunting, now too young to retire. Qi, 28, a white-collar worker in Shanghai, said younger workers were being asked to work so hard that it was doubtful some would make it to their 60s, and even if they reach that day, will there still be a pension? It's very challenging for the post-90s generation and those who follow, said Qi. End quote. State media has responded to the social anger with a series of articles justifying the need to raise the retirement age. Last week, the state-run Global Times wrote, for example, quote, "Currently, the average age expectancy of Chinese people has reached over 78 years, yet the retirement age remains one of the lowest in the world, 60 for men, 55 for women in white-collar jobs, and 50 for working-class women. The current retirement age was set more than 70 years ago, when the average life expectancy of Chinese people was only about 45 years. Now it has reached 78.2 years. An unchanged retirement age cannot catch up with the current demographic and economic situations in an era of longevity." End quote. In response to public concerns that the pension is running out, even the state-run publication couldn't spin it, simply expressing to its domestic population, quote, "We individuals are primarily responsible for taking care of our own retirement. One should have a full understanding and mental preparation for this." End quote. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a good Monday, have a productive week, and I will see you all tomorrow.